Today we're going to cover some basics on implied volatility in reference to options. So if you do me a favor, hit like and subscribe, and let's get into the video.
Welcome to this explainer. Okay, tell me if this sounds familiar. Have you ever placed an options trade, watched the stock move exactly the way you predicted, but somehow you still lost money? If you trade options, I can almost guarantee you felt that exact sting. It's literally the worst, right? Well, today we're going to uncover the hidden mathematical force that secretly dictates option pricing. It's kind of like the invisible hand moving the market. And by the end of this, you'll know exactly how to use it to your advantage. So let's dive right in. Here's our roadmap for today. We're going to start by solving the option pricing mystery, then we'll define implied volatility, see exactly how it prices premiums, look at real-world events, and finally learn to use IV rank and percentile. Simple as that. Section 1. The option pricing mystery, when winning trades lose money. So here's the million-dollar question. Why do your option premiums sometimes fall even when the stock price goes up? You know the drill. You buy a call option, the underlying stock actually pushes higher, but your options contract just starts losing value. Or maybe it just flatlines completely. It is incredibly frustrating to be dead right about a stock's direction, but still end up with a losing trade. Look, you aren't going crazy, I promise. You're just experiencing the effects of the invisible force we're unpacking today. Which brings us to Section 2, defining implied volatility, or IV. The market's fear gauge. So what is it? Implied volatility is basically the market's expectation of how much a stock might move in the future, and it's expressed as an annualized percentage. Think of it kind of like a weather forecast. If the meteorologist says there's a 70% chance of rain, well, that's not a guarantee you're going to get wet. It just tells you the odds based on current atmospheric pressure. IV is the exact same thing. It's a probability range, not a locked-in certainty. And remember, it is always forward-looking, and it's always quoted as a percentage over the course of one full year. Now, that percentage you see quoted in your trading app, it actually represents a very specific statistical probability. It's a one standard deviation move. All that means is there's a 68% probability that the stock will stay within this expected range over the next year. So let's say a $100 stock has an IV of 30%. The market is basically forecasting a 68% chance that the stock is going to end up somewhere between $70 and $130 in a year. And here's the kicker. It absolutely does not care if it goes up or down. IV is strictly about how wild the ride is going to be. Let's move on to Section 3, how IV prices option premiums. Why some options cost more. Let's compare two really similar stocks, Pepsi and UNP. As you can see, they're both trading right around $102 to $103. Now, if you want to buy a call option with the exact same amount of time until expiration, you'd naturally assume they'd cost roughly the same, right? But take a look at the premiums. The Pepsi call option is only 80 cents, while the UNP call option is $2.72. So why on earth is UNP more than 3 times as expensive? The answer is implied volatility. Pepsi's IV is a nice, calm 16.4%, but UNP's IV is almost double, sitting at nearly 31%. The absolutely crucial point to understand is this cycle right here. Market sentiment drives option prices, and option prices drive implied volatility. It's honestly a lot like hurricane insurance. When a massive storm is brewing off the coast, insurance sellers are going to demand way more money to take on that risk. At the same time, option buyers, who are expecting big, destructive market moves, are totally willing to pay those inflated prices to protect their portfolios. So this intense battle of supply and demand bids the price of the option up, which, in turn, pushes that implied volatility percentage higher. And that leads us perfectly into Section 4, real-world IV events, what causes uncertainty. So what actually creates that approaching storm in the market? Well, basically any scheduled or unscheduled event that creates a massive question mark. That's what injects uncertainty into the market. We're talking about things like quarterly earnings reports, national elections, major government budget announcements, or even sudden global events like pandemics or sharp unexpected market drops. Whenever the market doesn't know what's going to happen tomorrow, traders rush to buy options for protection, and that drives those premiums straight through the roof. Now check out this pattern. Right before a big event, like an earnings report, you're going to see IV steadily inflating, kind of like blowing up a balloon. Everyone is out there buying options to prepare for a massive move. But the very moment those earnings are announced, the second the news is out and the uncertainty just vanishes, that balloon pops. IV crashes immediately. In the trading world, we actually call this IV crush, and here is why this is so important. Even if you predicted the stock would go up, and it actually does, that sudden collapse in IV might erase the value of your option way faster than the stock price can increase, and boom, that is exactly why your winning trade might actually lose money. Okay, so how do we defend against this? Let's move to our final section. Section 5, IV rank and percentile. Is the option cheap or expensive? There's a really common trading myth out there that a raw IV number tells you everything you need to know. It really doesn't. A 100% IV might actually be dirt cheap for wildly speculative tech stock, but a 25% IV, that might be historically incredibly expensive for a slow-moving utility stock. The takeaway here is that you can never, ever look at an IV number in a vacuum. You always have to compare a stock to its own historical average. And that is exactly the problem that IV rank solves. Let's say you look up a stock and see it has an IV rank of 86%. What does that actually mean? It means that over the last 52 weeks, the implied volatility was lower than today's level 86% of the time. It was only higher 14% of the time. So this tells you instantly, right off the bat, that today, right now, options on this stock are relatively very expensive compared to their normal baseline. Which brings us to the ultimate golden rule of options trading. Buy options when IV is low and sell options when IV is high. Why? Because volatility almost always reverts to its mean. If IV is insanely high today, it's highly probable it's going to drop back down to its average soon, crushing the option premium. So if you sell an option when it's high, you collect a fat premium up front and just watch it deflate. On the flip side, if you buy when IV is low, you're snagging a cheap premium that has plenty of room to expand. All right, let's summarize all this into a practical, repeatable process you can use every single time you trade. Step 1, pick your stock. Step 2, check the raw IV percentage so you understand the market's expected yearly move. Step 3, since IV is annualized, remember to convert it to your specific time frame. If you're trading a monthly option, you're only dealing with a fraction of that expected yearly move. And finally, step 4, always check the IV rank to see if the current premium is actually cheap or expensive compared to its own history. Don't skip that step. I want to leave you with this final provocative thought. The next time you open your portfolio and look at your options contracts, I want you to ask yourself, are you actually trading stocks or are you just trading volatility? Because as we've seen in this explainer today, understanding the underlying company, that's really only half the battle. When you finally master the hidden math of implied volatility, you stop guessing and you start trading the actual mechanics of the market itself. So keep exploring, keep learning, and hey, start checking those IV ranks.
Thank you for staying to the end. If you haven't yet, please give me a like and subscribe. It means the world to me and helps me make more videos. Thank you so much. Goodbye.